Welcome back to Curious Commerce, the topic cash flow statement, part 8. Today's session we will discuss about financing activity, practical examples related to financing activity, and the cash flow statement format. In a cash flow statement, the final section is financing activity. After understanding operating and investment activities, financing activities explain how the company arranges money and repays money. Financing activities are related to raising capital for business, repaying borrowed funds, providing returns to owners. In simple words, financing activities show how business gets money and how it returns money to investors and lenders. Once again, the basic question may be arise why it is important. Ever a business needs money to start operations or for expand business or for purchase assets or for manage long-term growth or all the reasons. This money comes from the owners or the banks or financial institution. Financing activity shows these funding decisions. Certain examples of financing activities. Let us understand common financing transactions. Issue of shares. When a company issues shares, it receives money from investors. For example, shares issued worth rupees 4,000, cash increases, right? This is cash inflow. So second general example is raising long-term loans. When a company takes loans from bank or any other financial institutions, cash comes into business. The third one is the repayment of loans. When loan amount is repaid, cash goes out of the business. This is cash outflow. The fourth general example is payment of dividend. Dividend is profit paid to shareholders. For example, the dividend of rupees 1 lakh leads to cash decreases. This is also the financing cash outflow. Financing activities deals with owners' funds, borrowed funds, and returns to investors. It does not include daily business expenses. Let us discuss the practical example. Let us calculate the financing cash flow transaction of issue of shares of rupees 4 lakh and loan repayment of rupees 1 lakh 50,000. The step-by-step calculation is cash inflow, the issue of shares. Automatically the company or the business received the money, right? It is 4 lakh rupees. And the repayment of the loan, it is the cash outflow, it is 1 lakh 50,000 rupees. Net financing cash flow is net cash flow equals inflow minus outflow. That is 4 lakh minus 1 lakh 50,000 rupees. That is the difference is 2 lakh 50,000 rupees. This is positive. The, the meaning of positive cash flow is the cash increases due to financing activities. This means company raised more funds than it repaid and the business received additional cash support. This cash can be used for expansion or for operations. Easy Memory trick for remember, money received leads to cash inflow, money returned leads to cash outflow. Final understanding of this concept, financing activities help us understand how company raises funds, how it repays loans, and how it rewards investors. A cash flow statement shows how cash moves in and out of the business during an accounting period. It answers one important question: where did cash come from and where did it go? The statement has a standard format used by all the companies. The cash flow from operational activities. This is the first and most important section. It shows cash generated from normal business operational activities and selling goods or services and day-to-day business activities. In this section shows positive cash, it means the business operations are healthy. The second one is the cash flow from investment activities. This section shows purchase or sale of long-term assets and investment made for future growth. For example, buying machinery, selling land, purchase or sale of investment. This tells whether the business is expanding or selling assets. The third one is the cash flow from financing activities. This section shows how business raises funds, how it repays loans or pays dividend to the shareholders. It shows funding decisions of the company. The fourth one is net increase in or decrease in cash. After calculating all three sections like operating, investing, and financing, we calculated the net change in the cash. If result is positive, cash increased. If negative, cash decreased. The fifth one is the opening cash balance. This is the cash available at the beginning of the year or beginning of the accounting year. It comes from last year's closure balance. The last one is the closing cash balance. Closing balance equals opening balance plus net cash changes. This balance appears in the company's balance sheet. The flow of the format: opening cash, then the operating cash, then the investing cash, then financing cash leads to closing cash. The complete practical illustration overview. Assume company starts the year with opening cash of 1 lakh. The cash from operations or business earn cash through the operations is rupees 2,50,000, that is cash from operations. Company purchases machinery, the investing cash flow, that is negative 1 lakh, that is the cash outflow. That's why I mentioned that negative cash flow. Negative cash flow means generally we use it as called as in the cash outflow. The fourth one is the cash from financing. Company issue shares, financing cash flow of rupees 1,50,000 rupees. Now we should calculate the closing balance, net cash changes in that specified financial year or the accounting year. That is 2,50,000 minus 1 lakh plus 1,50,000 rupees. The net cash changes is 3 lakh rupees. That is 3 lakh rupees positive, it means that it is increase. The closing cash is opening cash plus increase. That is, the closing cash is 1 lakh plus the increase is 3 lakh leads to 4 lakh rupees. Final understanding, cash flow statement shows cash earned from operations, cash invested in assets, cash raised or repaid, and final cash position. Profit shows performance, but cash flow shows survival of the business. Thank you for watching. Please subscribe to Curious Commerce. Follow our WhatsApp channel, Curious Commerce Financial Management Hub, for daily finance learning. The topic, cash flow statement, will be continued in part 9.